All right, welcome to the deep dive. Today, we're embarking on a crucial mission, really, to cut through all the noise and distill the most critical insights from a really comprehensive source, the Guide to the Markets report.
Yeah, it's packed.
It really is.
Yeah.
And this isn't just, a collection of charts. It's a living document full of the latest data, analysis on key economic indicators, investment trends, those timeless financial principles.
All compiled by a global strategy team, so it's got that broad perspective.
Exactly.
And our goal for you today, I think, is simple. Think of this deep dive as your shortcut, basically, to being incredibly well-informed.
Right.
We'll connect everything from, say, the intricate dance of global growth and inflation to market valuations and even surprising factors like the real economic impact of climate events.
Yeah, like on your food bill. Things you actually feel.
Exactly. It's about understanding those powerful forces shaping today's financial landscape.
Okay, let's do it. Let's peel back the layers, starting with the basics, those global economic currents.
Foundational stuff.
Yeah. What's the latest on growth, business activity? Is it the same story everywhere, or are there differences?
Well, when we look at the consensus forecasts, the real GDP growth numbers, China really stands out.
Okay.
Still resilient, projected at, 4.9% for 2024, maybe 4.5% for 2025. They're definitely leading the pack among the majors.
Right.
But what's also telling is the divergence in developed markets.
Ah, okay.
The U.S. shows a solid path, moderating a bit, but solid, like 2.4% for 24, 1.9% for 25. But contrast that with the Eurozone and the U.K., much more subdued recovery. Eurozone at maybe 0.9% this year, UK even slower, 0.7%.
Wow, quite a difference.
It really suggests a multi-speed global economy, not everyone moving together, which, has big implications for where you might invest.
That divergence is really interesting. And speaking of real-time signals, the PMI, the Global Purchasing Managers Index, that often gives an early read, right?
Yeah, it's a key one.
Yeah.
On manufacturing activity.
So what are those numbers signaling now? And maybe just quickly, for anyone less familiar, what does that 50 mark mean? Above or below?
Sure. So the PMI is basically a sentiment indicator from purchasing managers. Gives us a forward look.
Right.
Above 50 means things are expanding in that sector. Below 50 indicates contraction. Simple as that.
Got it.
And for May 2025, the global manufacturing PMI. Well, it paints a bit of a mixed picture. Developed markets as a whole, just under 50, 49.8. Emerging markets, similar, 49.4.
So just shy of expansion globally.
Exactly. But if you drill down, the U.S. was just over 50, 50.5. China stronger at 52.0, both expanding.
Okay, some bright spots.
But then the Eurozone at 49.3, UK at 49.2, still stuck in contraction territory. So yeah, it's a global story of some areas pushing forward, others still grappling with headwinds.
So despite those bright spots globally, manufacturing is still kind of treading water.
Yeah.
Or even shrinking a bit in key places.
That seems fair, yeah.
Okay, understanding that mixed picture on growth, it's impossible to talk global economy without hitting inflation, everyone's favorite topic.
Or least favorite, perhaps.
Right. Are we finally seeing pressures ease? Or are things still, heating up?
Generally, the trend is easing. That's the good news.
Okay.
Take the Eurozone headline inflation. It was, 5.5% back in June 23? Now projected around 1.9% by May 25? Basically hitting the ECB target.
Right on target.
The U.S. also showing a downward trend, from 3.0% down to a forecast 2.4%.
So progress.
Definitely progress overall.
Yeah.
But there's still noticeable variance. Some countries like France, very low, 0.6%, Italy, 1.7%. Others like Germany at 2.1%, Spain, 2.0%, closer to targets. But the U.K., notably, still faces higher pressures, projected at 3.4%.
Still quite a bit higher there.
Yeah. And while those PMI input prices have come down from the peaks, they're still generally above 50.
So costs are still rising, just slower.
Exactly. Businesses are still seeing rising costs, just not as rapidly. And wage growth trends, US, Eurozone, UK, they've slowed down too, but central banks are definitely still watching that closely.
So headline numbers look better, but maybe stickier underneath. That above 50 suggests it.
Could be, yeah. It bears watching.
Okay, given all these dynamics, growth, inflation, let's shift to policy. Monetary, fiscal.
Yeah.
What are markets thinking about central bank rates and financial conditions? Are things getting easier or harder for borrowing?
Well, as of mid-June 25, market expectations are pointing towards easing from several major central banks anyway.
Like the Fed, ECB.
Yeah, the U.S. Fed, the European Central Bank, Bank of England. Markets expect adjustments signaling a less restrictive stance. The Bank of Japan, well, it's on its own path, but moving too.
Okay.
And overall, global financial conditions have eased somewhat, meaning borrowing costs are becoming less restrictive.
Which could be good for activity, right? Cheaper credit?
Potentially, yeah. It can help stimulate things if businesses and consumers can access credit more easily.
And on the other side, the fiscal side, government debt. How are those levels looking? And what about government investment? Are we seeing more public spending?
Government debt. Well, as a percentage of GDP for 2024, it's still significant, 120% for the US, around 90% for the Eurozone.
Still pretty high numbers.
They are. But what's interesting is the shift on the investment side. The average annual growth rate forecast for government investment, say 2022 to 2026 for the US, Eurozone, UK, it's substantially higher than in prior decades.
Really? So renewed focus.
Seems like it. A renewed focus on public spending, infrastructure projects, could boost long-term growth, but, it also adds to that debt burden. It's a trade-off.
Fascinating. More government spending potentially coming. Now let's talk about the consumer. Their financial health is key, right? Impact spending, momentum.
Absolutely crucial.
What are we seeing on consumer balance sheets globally?
Yeah.
And also things like U.S. trade policy uncertainty, immigration. How do those fit in? Feels like big factors.
Okay, consumer balance sheets. Some interesting dynamics. Household debt as a percentage of GDP. It's largely stabilized, maybe even dipped slightly in many developed economies. That's good.
Okay.
The really big story, though, is excess savings, remember, after the pandemic?
Yeah, everyone was talking about it.
Right. Households built up significant savings, but those have been drawn down considerably across the US, Eurozone, UK, Germany, Italy, France, Spain.
So that bucket is shrinking.
It is. Some cushion remains, but it's not as robust. Suggests consumers might be less able to fuel future spending spikes from past savings,
Right, relying more on current income.
Yeah.
And tying into that broader picture, U.S. trade policy uncertainty, the report flags spikes there. What does that mean globally?
Yeah, that uncertainty index has definitely jumped around. And the effective tariff rate has fluctuated.
Okay.
Recent announcements, campaign promises, they suggest potential for further tariff increases. Some proposals talk about a 20% universal tariff, even 60% on China.
Wow, those are big numbers.
Huge. And the real question is what that means for supply chains, corporate profits, ultimately consumer prices, if they happen.
A potential game changer for trade flows.
Could be. And as for immigration, it's become a surprisingly significant contributor to U.S. population growth.
More than a natural increase.
Often offsetting decline of natural increases, yeah. And that directly impacts labor supply, economic demand, potential GDP growth long term. It's a key demographic factor now.
So a lot of moving parts there on the economic front.
Yeah.
Okay, we've laid the bedrock. Growth, inflation, policy. The next big question for investors is always, okay, how are equity markets reacting?
Right, where's the money going?
Exactly. Let's dive into valuations and earnings. Everyone wants to know. Are global equities looking expensive right now?
Yeah, the valuation question. If we look at the MSCI World Forward PE ratio, that's a common metric.
Price to earnings, yeah.
Right. As of mid-June 25, it's sitting at 19.2 times earnings.
Okay. And how does that compare?
Well, what jumps out is that it's noticeably higher than its long-term average, which is around 16.4x.
So, yes, they do look a bit pricey globally on average.
Suggests that, yeah. Trading at a premium compared to historical norms.
But is that premium everywhere? Or are there regional differences? Maybe some markets offering a better deal?
Absolutely regional differences. While the global average looks elevated, if you dig down, markets like Europe, ex-UK, China equities.
Yeah.
They're currently trading at significant discounts relative to the U.S. market. The U.K. also trades at a discount.
Ah, so potential relative value there.
Potentially, yeah.
Yeah.
More attractive entry points, maybe, or just better relative value if you're diversifying away from the U.S.
And what about the E in PE, the earnings? What's the outlook there?
Good question. Consensus estimates for global earnings per share growth, they're actually positive across the board for both 2024 and 2025.
Everywhere. U.S., Europe, EM.
Pretty much. World, U.S., Europe, ex-UK, UK, emerging markets, China. Companies are expected to keep growing profits, which is, a fundamental driver for stocks.
Positive earnings growth is definitely encouraging. Okay, beyond the numbers, what about broader market trends? And concentration. That feels like a big topic, especially in the U.S.
Yeah, concentration is key right now. If we look historically first, bull markets in the MSCI world, They average about 61 months, delivered something like 314% return on average. Huge.
Wow.
Bear markets, conversely, shorter, maybe 16 months average, but with sharp declines, average negative 59%.
Oh.
It highlights that long-term upward bias of equities, but also the intensity of the downturns when they happen.
Right, and that concentration in the S&P 500.
Yeah, it's been a recurring theme. The top 10 stocks hold a really substantial share of market cap earnings expectations.
The Magnificent Seven effect.
Exactly. Apple, Microsoft, Amazon, Alphabet, NVIDIA, Meta, Tesla, they played an outsized role in driving performance, contributing hugely to overall earnings, makes the index very top-heavy.
Definitely something investors are watching closely. What about equity income? Are companies giving back cash? Buybacks, dividends?
Yeah.
What are the trends?
We see a pretty clear regional split there. U.S. equities tend to favor buybacks more, higher buyback yields compared to dividend yields.
So companies buying their own stock back.
Right. Whereas in Europe, ex-UK, the UK emerging markets,
Yeah.
generally a stronger focus on traditional dividend payouts.
Okay.
And the overall trend for dividend payout ratios, a slice of earnings paid out that's been fairly stable. Companies seem committed to maintaining those distributions.
Got it. Now let's shift gears again. Let's navigate the world of fixed income. We've covered equities, but bonds are crucial, right? Diversification, income.
Absolutely vital part of a portfolio.
So what are the current yields looking like across different bond types? And how are these global fixed income markets actually structured?
Okay, yields as of mid-June 25. Developed market government bonds offering around 3.1%. As you move up the risk spectrum, investment-grade corporate bonds, high-yield bonds, emerging market debt, they typically offer progressively higher yields to compensate for that extra risk.
Makes sense.
High yield, for instance, currently around 6.5%.
Yeah.
And duration sensitivity to rate changes that varies too.
And the structure. What makes up the global bond market?
It's vast, largely made up of U.S. treasuries, corporate bonds, non-U.S. government bonds. Country-wise, the U.S., Japan, and the euro area are the biggest segments. Just reflects the scale of their debt markets.
So a wide range of options. But what does this mean for returns?
Yeah.
Especially from government bonds. Has the way returns are generated coupons versus price changes shifted over time?
Yeah, this brings us to an interesting idea. The yield cushion.
Yield cushion.
Think of it like a safety net. It tells you how much yields can rise before that wipes out your coupon payment for the year through price declines.
Okay. How much buffer you have against rising rates.
Exactly. And how returns are generated has shifted. Back in the 1990s, the coupon payment was a bigger part of the total return for government bonds, more stable income.
Right.
In the 2020s, with lower starting yields generally, capital appreciation price changes plays a bigger role. Makes returns more sensitive to yield moves.
So more volatility potentially from price changes now.
Can be, yeah. Though things like the U.S. 10-year yield, it has typically fallen quite a bit during past recessions, providing some cushion that way. And those nominal and real 10-year yields in the U.S., Eurozone, UK, Japan, they show different levels reflecting different inflation outlooks and policies.
And what about spreads? The extra yield for taking on more risk, like corporate bonds over government bonds. Are spreads tight or wide now?
Global fixed income spreads, U.S. investment grade, Euro IG, U.S. high yield, EM debt, they're currently within their historical ranges.
Okay.
But generally on the tighter side compared to, say, periods of major stress.
Meaning investors aren't demanding a huge premium for risk right now.
Relatively speaking, no. It suggests moderate confidence in the market. The perceived risk of defaults isn't seen as exceptionally high at the moment.
And speaking of risk, high-yield bonds definitely come to mind. What are the trends there? Spreads, defaults? How do they link to the economy?
Yeah, high yield spreads to extra yield over safer government bonds. They tend to widen out significantly during downturns.
Reflecting higher risk.
Exactly. Investors demand more compensation. And correspondingly, default rates in both U.S. and Euro high-yield markets tend to rise during economic contractions.
Okay.
There's a clear historical link. When corporate earnings fall, those earnings drawdowns we talked about, U.S. high-yield default rates tend to rise right alongside.
So a real barometer for corporate health and the economy.
Very much so.
Okay, let's broaden our view now. Beyond the traditional asset classes, let's dig into themes like ESG, environmental, social, governance.
Increasingly important.
Definitely. What's the latest on, say, climate events and their tangible impact? You mentioned food inflation earlier. That sounds like a direct link to everyday life.
It absolutely is. And the data here is fascinating because it connects these seemingly abstract climate events to really concrete economic impacts.
Like the heat wave.
Exactly. That 2022 summer heat wave in Europe, the estimate is it added a significant 2.0 percentage points to annual food inflation.
Wow, 2%.
Yeah. It's not just an environmental issue. It's about the cost of living, economic stability, how climate hits your wallet.
That really drives the point home.
Yeah.
And what about carbon pricing? Are more countries actually putting a price on emissions now?
There's definitely growing coverage globally, more carbon pricing initiatives popping up, signals a bigger commitment to curbing emissions.
Like emissions trading systems.
Right, ETS systems are more common. The EU ETS, for example, recent prices have been around, say, 80-90 to a ton of CO2 equivalent. That's a substantial cost to emit.
But not everywhere is the same.
No. China's ETS, for instance, is considerably lower, shows different approaches, different stages of development across major economies.
Okay, let's zoom out even further. Global CO2 emissions, the huge task of energy transition. Who are the biggest emitters, and how's the world's energy mix expected to change?
All right, big picture emissions, 2023 numbers. China's the largest share, around 30%. US next at about 14%, then India at 8%. The UK and EU combined also around 8%.
And per person.
Per capita, the US and China were both higher than the global average.
And the energy transition, how we power everything. Transport, buildings, industry.
That's projected for a dramatic shift between 2020 and 2050.
Yeah.
We expect to see a notable decline in fossil fuels and a corresponding massive increase in electricity, e-fuels, hydrogen. It's like a fundamental rewiring of the global energy system.
A massive shift. So what does that mean for investment? Climate mitigation, adaptation? Is the money flowing where it needs to?
Well, global investment in mitigation and adaptation, especially renewables, grids, battery storage, it is projected to grow substantially.
Right, I sense a but.
But here's a challenge. There's still a significant adaptation financing gap for developing countries. We're talking hundreds of billions of USD annually.
So current investment isn't enough for the future need.
Doesn't look like it's meeting the projected need, no. Poses a real challenge for global climate resilience.
And electric vehicles, EVs, huge part of this story. How are sales doing? And what about the minerals needed? Are we just swapping dependencies?
EV sales have seen incredible growth, really rapid market penetration, especially China, Europe, clear shift in consumer preference policy.
Yeah, you see them everywhere now.
Right. But the mineral content point is crucial. EVs need substantially more graphite, nickel, lithium, cobalt compared to conventional cars.
So less reliance on oil, more on these critical minerals.
Exactly. It creates a new reliance on those specific supply chains. It's a different kind of dependency.
Finally, within this broader ESG theme, green bonds, social bonds, sustainable bonds. Are these still niche, or are they becoming significant?
Definitely becoming significant. The issuance has grown dramatically over the last decade.
These are bonds for specific projects, right?
Exactly. Directing money specifically to environmental or social projects. We're seeing growth across different types, like sustainability-linked bonds, too, and robust activity in Europe, North America.
Yeah.
It shows sustainable finance is rapidly moving mainstream.
Okay, that was a really comprehensive look at how markets work, ESG themes. Let's try and tie this all together now. Look at core investing principles, the long-term outlook.
Bringing it home.
Yeah. How does something like, say, life expectancy, which might seem separate, actually feed directly into financial planning?
It's fascinating and incredibly direct. Consider this. A 65-year-old couple today.
Okay.
There's a 76% probability that at least one of them will live to age 80, and a 34% chance at least one hits 90.
Wow. Those are high probabilities.
They are. It means financial plans have to account for potentially much longer lives than before. Your money needs to last longer. Changes the whole calculation for saving and investing.
Really underscores that need for long-term thinking. And speaking of long-term, compounding, we hear about it all the time. Can you give us some really powerful examples? Show just how potent it is.
Compounding is, it's almost like financial magic, isn't it?
Feels like it sometimes.
Imagine investing, say, 5,000 euros every year, getting 5% growth per year.
Okay.
If you start at age 25 versus waiting until 35, the difference over time is just astounding.
How much difference?
Starting at 25, investing for 40 years, you could end up with over 600,000 euros. Start at 35, only investing for 30 years, maybe 350,000.
That's hundreds of thousands difference just from starting 10 years earlier.
Exactly. Or look at reinvesting dividends versus not. On something like MSCI Europe, the difference in total return long-term is huge. often double or triple the final amount.
It really makes you think about those small, consistent decisions today, doesn't it?
It really does. Time is your greatest asset.
Incredible numbers. So what about overall long-term performance? Equities, bonds, cash, how have they stacked up over, say, the last century plus? What's the big takeaway?
The long-term data just clearly shows the superior power of equities for growth.
How superior?
If you invested a single dollar in real terms, inflation adjusted, back in 1900, in equities,
Yeah.
by 2024, it would have grown to an astonishing $3,953.
Wow. And bonds, cash.
Same dollar in bonds, just $8 in cash.
Only $2.
That is stark.
It really highlights equity's unmatched long-term real returns, a powerful reminder of where wealth has historically been created.
But as you said, investing isn't always smooth sailing. There are those drops, those intra-year declines that can feel huge.
Right, the volatility.
What does that tell us about staying invested even when things look rough?
It's such a critical lesson. Look at MSCI Europe again. Average intra-year drop, peak to trough within a year, is about 15.2%. Feels significant. Yeah, that would make anyone nervous.
But despite those average drops, annual returns were positive in 34 out of 45 years.
Most years ended up positive, despite the bumps.
Exactly. It powerfully reinforces that idea. Short-term volatility is normal, often significant, but staying invested for the full year usually pays off. The long-term trend is often upward.
So trying to time the market is tough.
Very tough. And there's that clear historic risk-return trade-off too, right? Cash is low risk, low return. Global equities, higher risk, higher potential return. Other assets fall in between.
That's a crucial point for managing expectations. And how do different asset classes move together or not?
Yep.
Correlations. How does that help build a resilient portfolio?
Correlations are absolutely key for diversification. You don't want everything moving up and down together.
Right.
The S&P 500 versus US 10-year treasuries, for instance, their correlation can shift. Sometimes bonds hedge stocks, sometimes less so, depending on things like inflation.
Okay.
And looking at public versus private markets, certain assets like commodities, timber, direct lending, they often show low correlations with traditional stocks and bonds.
Making them valuable diversifiers.
Potentially, yeah. They can help smooth out returns when other parts of your portfolio are struggling. It's about building that portfolio where not all your eggs are in one basket. Different things perform well at different times.
Makes sense. So after this incredibly thorough deep dive, global growth, inflation, valuations, climate, investing principles, what does this integrated view mean for the future? What are the long-term expectations for investors?
Well, it all feeds into insights like JP Morgan Asset Management's long-term capital market assumptions. These are forecasts, expected nominal returns for the next 10, 15 years.
Factoring in everything we've discussed.
Exactly. Growth, inflation, valuations, policy, it all goes into the mix. And generally, global equities are projected to offer strong returns. While things like Euro government bonds, Euro cash, naturally lower expected returns.
And diversified portfolios like 60-40.
Right. Diversified portfolios like a global 60-40, 60% stocks, 40% bonds, or maybe a 50-30-20 adding alternatives. They're expected to provide that balance of risk and return.
So the overall message is?
The overall message, I think, is that while the path will definitely have its ups and downs, the long-term outlook for thoughtful, diversified investing remains compelling.
This deep dive has really brought together so many pieces, hasn't it? Macro shifts, markets, climate, long-term principles, offering this truly integrated view of the global financial landscape.
Yeah, seeing how it all connects. It's not just about knowing the individual numbers, but understanding what they mean together for the bigger picture.
Exactly. And maybe here's a final thought for you, our listener, to mull over. Given that incredible power of compounding we talked about, even small, consistent decisions you make today, informed by understanding these complex dynamics, they can lead to profoundly different outcomes over your lifetime.
Absolutely.
So the question is, how might integrating this deep dive knowledge influence your own long-term financial roadmap?
Something to think about.
Definitely. We encourage you to continue your own deep dives, stay curious, and keep connecting those dots.